let me get into two special guests. Sarvendra Srivastava is technical strategist at Emkay Global. He joins us to run us through what he makes of the charts. Mr. TP Raman is managing director at Sundaram Mutual Fund. He joins us after a long time. Gentlemen, great having both of you with us here on the show. Thanks very much. Sarvendra, let me start out with asking you, typical of the kind of market that we've had ever since the market broke above this 55.50. I'm talking about today's market, almost symptomatic of what we've seen so far. Very strong 3-4% kind of moves in large cap stocks, leading the charge, and then a little bit of buying in the mid to smaller areas of the market.
Right, I think the participation is slowly improving, and you are seeing larger stocks, or the basket is slightly improving, but not yet to the extent when we broke out of 55.50. That was a very good move. It lasted 6 weeks. Last 2 weeks have been negative closes, so market could find some time here, consolidate. Short-term averages started to whipsaw, so our 21-day exponential moving average has started to whipsaw almost on a daily basis now. So yes, market could spend some time in the 6,000-6,150 range, and once this range breaks, I think you would be in for a more meaningful move. But looking at the weekly charts, you would want one healthy dip towards 58, 58.30 for a test of strength before the next leg unfolds, because that would give more meaning to the next leg up. And if that does not happen, then probably after doing upper channel targets, which are right now pending at around 65, 65.50, market would then probably cool off a bit.
So you would say we are now once again in slightly indecisive sort of zones, because it was a vertical move up. Now that doesn't seem to be the case. A bit of volatility returning.
Yeah, volatility is definitely returned, and as I said just now, shorter term trend averages have started to whipsaw. Market stayed clear of the 21-day exponential moving average almost for six odd weeks, and now that it started to whipsaw, you would definitely see some kind of if not a price consolidation, a slight time-wise consolidation before the next leg unfolds. But basically the bias would remain that a mild correction towards 58.30, 5800 would be good as far as the technical picture is concerned if it comes.
So you're expecting that to sort of test, and then from there, if the
yes,
market...
definitely. Once we fall back towards the previous cluster around 58, 58.30, that was an earlier support cluster, and is also a 50% retracement to the move that we had from 53 onwards till 6284 on Nifty. So that price area is a very good support, and usually good trends, usually once the corrections or pullbacks happen, they usually fizzle out between 50 to 61%. So 50% is around 5800, and I would assume that 58 would be the best case correction levels that the Nifty would do from here.
Okay.
Let me get Mr. TP Raman in as well. Mr. Raman, afternoon. Thanks again for joining us. Away from the technicals, what are the fundamentals of this market looking like to you? We all seem to be resigned to the fact that this is all liquidity driven, foreign liquidity driven to be more precise. But in terms of the actual valuations, the earnings growth, how is the market looking to you from those parameters?
See, there is no doubt that, the current trends that we are seeing in the last few weeks, or at least a couple of months, is definitely because of the liquidity that has been happening in the market. But having said that, it is also true that, the fundamentals are also beginning to look good, despite some, not so good news coming as far as, India is concerned in respect of the IIP growth or numbers, of that sort. But, I think on balance, I would say that if you look at the earnings right now, it looks as though the valuations are a bit stretched. And if you look at, our market vis-a-vis the other global markets, it might look that, it's a little bit stretched. But if you look at the other side, I think if you look at the earnings, now if you are saying that about 19 to 20% earnings is going to be a done deal, if this is what I think we can reasonably predict, I think we are fairly attractively valued from that point of view. And as far as I think the Indian market is concerned, I think everything is in place, excepting that I think some positives, like some more emphasis on infrastructure, some more data coming on infrastructure growth, some more data coming on energy growth, and I think GDP growth as well. And I think more importantly, and I think it's very important, I think some measures on the supply side management of inflation, I think they should help.
Mr. Raman, just talking about liquidity, but focusing on the domestic liquidity side in mutual funds in particular, There's been a lot of talk about the fact that the redemption pressure on equity mutual funds is continuing, and that's sort of a trend which has gone beyond just a couple of weeks or a month. What is your own reading? Is there sort of a change in the perception of the retail investor and hence a shift towards debt mutual funds, or is that too early to take get a firm view on that?
I wish it happens that way. I mean, if money moves from equity to debt is fine, but I don't think retail monies are really moving into the debt mutual funds. I think what is happening is the wholesale money is moving into the debt mutual funds. So all the 500,000 crores that you see in the fixed income segment is mostly corporate institutions and at best HNIs. I don't think the real retail is moving into this segment, although, I think fund houses are making every effort to do that. And there are, it's only the liquid segment and the ultra short-term segment that is attractive at this point in time. But, in spite of all this, the redemptions that we are seeing in the equity, there is no doubt, I think the industry has been seeing net outflows. And that is more because I think this profit booking has become the rule of the day, and I think people are comfortable having, got in at different levels over the last couple of years. And when they see that, there is either they are quits and they want to get out, of their investment, or if they feel that they have made some money or there is an opportunity to make some money, they would like to come, they would like to, book their gains. But I think they will wait and see it. I think that at an opportune time they will definitely come back, because I think they have had this experience in the last 4 or 5 years of, a market going down steeply and also market rising steeply. I suppose the investors will take the right call, and then, I mean, we are hoping from the, as a fund house that these monies will eventually come back. But having said that, the real retail, which is the SIP, is happening in a significant way. I don't think there is any deterrent to SIP happening.
Right, Mr. Raman, after the move that we've already had so far, and we are almost at new life highs, where do you think this market is headed? Do you think the current leg up will continue in a meaningful way? So we could have another 20-25% sort of a move in this market, with of course 5-7% kind of corrections along the way, but the risks to the upside remain more than the risks to the downside. Would you say that's the case? And if that is the case, then by booking out profits, selling now, I'm talking about local investors, is that the right decision? And would you say that most of the selling which we get, the number that we get every day from mutual funds, local investors, all of that can be explained away by redemptions, or is there at least a small portion of fund managers, etc., which probably is trying to create a bit of cash as well? Or that's not the case, it's all redemptions? Just a couple of questions combined into one.
It's basically redemptions, and then going back to your question now, is the investor right in exiting at this point in time? Look, if you look at it from where the investors had, he's not too sure, because 20,200 or 20,400, he feels that it is a great level. This was what happened in 08 and the earlier 2009. So he's not too sure, in terms of whether the market will go to 23 or 24, despite some kind of a write-ups appearing that the market is going to be up for 25-30%. I don't think he's in a position to say that what is the concrete proof that I have that the markets will go to enable me to stay invested. But I think he would like to book gains whenever it is possible. So he says a bird in hand is worth two in the bush. This is the typical investor's attitude. But from a fund house perspective, we know that there are no global bad news that is happening, or at least no bad news is coming from that. And it's probably time that some good news will start flowing in, and from that perspective the market should look better should start moving upwards. And the Indian fundamental story remaining in place, and with things happening in a reinforced way, in a much more vigorous way, I think we should be fine. But going back again from an investor perspective, I don't think the investors are willing to buy any idea that the market is going to these kinds of levels, because it will need some kind of a demonstrable proof, which I think it's very difficult. I mean, it's hard to predict which way the market will go, because the markets have been moving and again correcting. So I think this will probably be the order of the day.
Sarvendra, you were talking about risk rewards, I think, a couple of weeks back.
Yeah.
How does that sound, stack up?
Right now you're bang in the middle. So you would want risk rewards to be slightly higher if you want to trade on the long side. So if upsides are capped at 65 and you are trading 62, 61.50 and stop loss at 58, so leaves you with a 1:1 kind of risk reward, which probably is just a trading kind of a risk reward. Investors would want a risk reward in excess of 1:2, 1:3 kinds to trade with conviction. So I think those risk rewards are right now missing in the market.
Are a lot more of the investors that you deal with, investors who deal via your desks, etc., a lot more people getting, intraday or rather trading oriented, rather than taking positional long, slightly longer term bets?
Not really. I think stock specific people definitely have a buy and hold kind of a strategy, and whatever they are using on the trading side is Nifty futures, if at all someone is doing that. But yes, they are cautious, and yes, the trading books are slightly smaller than probably what they would have been earlier. So that activity is definitely slightly less. And looking at the kind of volatility that we are doing every 2 days, we are doing 200 points up and down on Nifty. I think people will definitely, if at all someone was trading aggressively, would have definitely reduced the bet size and wanting to stay away unless until you break out of this range.
Welcome back. 111 points on the Nifty spot. About 5 or 6 minutes to go as far as market closing is concerned. Sarvendra, let me get some sectors out of the way. Metals, you believe, is in for some weakness?
Yeah, metals is one space that looks weak. The index itself looks weak, and the individual constituents, starting with the Tisco, looks weak. Hindalco also could give you a 5 to 7% kind of a correction, or a Sasagua, which can give you in excess of 10% correction from current levels. And apart from the stock specific picture that is emerging on the charts, one more thing that would support that view is our view on dollar. So dollar, we believe, is in making secular bottoms across with major currencies, so including JPY, Euro and Indian rupees. Indian rupee, we still have pending targets at 42, 42.50, but once those targets are met, I think from there on dollar has only one way to go, and that is up. So, and we believe that as long as DXY, which is the index of a basket of currencies, as long as that is holding above 75.50, I think the DXY has got a very, very, very bright chance to do a 10 odd % kind of a move. So 84, 85 is very much possible for the DXY, and 10% move on dollar, I think, should definitely spell trouble for the metal space.
Not only metal space, but equities in general. Equities
in general, and that is where we said that the short-term bias is slightly negative, and we are looking in for a healthy correction towards 58, 58, 30 to buy into this market once again aggressively. So whatever we bought, say, around in the breakout of 55, 50, 56, we've booked profits and we have lightened positions. So right now we would be just a couple of stocks which would be on the long side, say for an Infosys or an Andhra Bank. But rest, whatever 15, 20 stock exposure that we took are by and large all out of the system. So to add back into this market, since the basic nature of the market has become a buy on decline, you would at least want a decent correction. So 58, 58, 30 is what we are looking at to add longs. If at all that does not happen and market breaks out of 61.50 in and around expiry, then probably we'll have to relook and re-strategize as to what to do.
Mr. Raman, just coming back to you, and get from the notes that you're bullish on the infrastructure space. That's again a space which has its fair share of skeptics. There are enough people who are saying that despite the noises, all the talk, the execution is simply not going to pick up. You haven't done anything in terms of your land acquisition norms, for instance, in linkage to the road development story, plus other issues continue to remain. You are hopeful that those will get ironed out, and in that sense, infrastructure linked stocks and companies you would buy into right now?
Absolutely, absolutely. See, we do take a long-term view. We know that there are a lot of glitches, there are a lot of hiccups along the way. Things are not happening as they should, and but then the long-term story is in place. So we are only now, hoping and I think wishing that the things get speeded up, particularly the laying of the roads from, let us say, 12-15 kilometers to about 25-30 kilometers. Things get done fast. The power plants get erected fast, and then they get into power generation fast. See, but we do take a long-term view, but yes, short-term there are concerns, things are not happening. So from that perspective, some of the funds in that particular category may have periods of underperformance. But I mean, I think, on the medium to long-term, we are quite bullish on that. I mean, these things need to happen, and we are sure it will happen.
In the shorter term, is the consumption story a much better bet? And actually this time around it's back to urban consumption, not so much rural consumption, which used to be the buzzword about a year and a half before this entire sort of slowdown came. Are we back to the urban consumption story, and hence consumer discretionaries become the favorite plays again?
Yeah, it's true that urban consumption is happening. It's not to say that rural consumption will not happen. We need to wait. Now monsoons are almost over, and I think the record so far has been good. So you need to give them some some lead time for for them to cash out on this whatever I think the good monsoon, they reap the benefits of this monsoon. And I think you'll soon be seeing. I mean, we must be seeing the unleashing of the rural money power as well into the markets. I think consumption, yes, is a good story. Definitely, it's a good story.
Okay, we're done for the day. That's the closing bell. We've shut shop at 6092 on the Nifty, 109 points higher, 2227 on the Sensex. That's about 355 points up. The Nifty futures front month contract has ended at 6120. So that's a 30 odd point premium compared to the spot. The middle month contract has ended at close to about 6150 or so. Hindalco ends up about 5%. You have Bharti, which ends up 5, Ambuja Cements ends up 5, Sun Pharmaceuticals 4, HUL 4%, Cipla ends up about 3.5, Suzlon 3.5, ITC 3%, Reliance Industries 3%, SBI 3%, Axis 3%, whole lot of 3% movers in trade. Just 4 stocks, actually 5 names in the Nifty 50 basket and down, and just one over 0.5%. HCL Tech is the only stock out of the 50 names which ended the day with a cut in excess of about 0.5% or so. Strong, very strong looking market. Almost, Sarvendra, makes you wonder. This is almost looks like some very strong index buying today's market.
Yeah, let's see how long it continues, because as I can see from the intraday ticker itself here, 6150 has been the pressure point. So from intraday highs around 6150, market has reacted today itself.
Right.
And futures is witnessing some kind of a selling pressure around 6150, 6160. So that remains the key hurdle, and 6150 remains the trading range as of now for the next, say, couple of sessions before you see any meaningful move either side. And 6150 to me remains a pressure area, and you definitely need at least a daily close above that, and markets to hold above that in the next session to then again want to re-enter the market on the buy side from current levels. But yes, if you get a 150 to 200 point correction, I think around 5850, 5800, this market definitely remains an attractive buy, and buying would continue. And one important thing within this fall is that you are seeing slightly lighter volumes. So if you look at volume signatures, which were slightly inverted, say 6 months back, which means when the market was falling, you were seeing volumes which were dipping, increasing, and when the market was pulling back, you were seeing that volumes which were dipping. Now the reverse has started to happen, which means volumes are conforming to price. On rallies, the volumes have started to expand, and on contractions, volumes have started to contract. So that's a very, very good, healthy bull market signature. One definite positive from the current move is that in this rally, the volumes expanded, and within this correction of the last 4-5 days, volumes have definitely contracted.
Okay, mid caps, a lot of banks.
Lots of everything, actually. You were talking about strong movers within the Nifty, within the NSE broader basket. There are some, I think, handful of 10 to 20% movers. Just going to name some of them. You have Tulsi Extrusion, strong volumes there, 16% bump up. Tilak Nagar, Eros International, again, fertilizers within the fertilizer space. Zuari Industries was a strong mover, 9% higher there. Some of the earnings linked story, Indiabulls Finance, for instance, was up about 8%. Good gains there. United Phosphorus, again, coming back to the fertilizer story. That's moving. Central Bank, Canara Bank, both strong movers, 6% plus gains on Central Bank, Canara Bank, and then Indian Bank also up about 6 odd percent. So again, within the broader markets, a lot moving, and a lot moving not just within one segment, Prashant, I mean across the various sectors.
Right. Mr. Raman, you want to outline some overweights right now? Any new ideas, any new calls, or any new stocks that your funds or fund managers have bought into? Anything you'd like to highlight?
No, while I'm constrained from making any stock-specific comment, all that I can say is that from I think if you take the broad asset allocation that we do, we are definitely overweight the financial sector and the consumer sectors, and a bit on the auto. We are a bit underweight on energy at the moment, and also metals at the moment, and we are equal weight on pharma and IT. So that's how broadly it is. But the funds, the kind of funds that we have, they will need to own the stocks in terms of their objectives and mandate. So, but I think broadly speaking, these are the kind of weights that we are maintaining at the moment.
Sarvendra, what are you doing with banks now?
See, upside targets on the banking index, just like the Nifty itself are pending. So if Nifty has upsides pending in the range of 65, 65.50, a similar kind of a bullish channel on the banking index or the bank Nifty which we trade is currently somewhere around the 14,000 mark. So from here, if Nifty, bank Nifty is trading around 12,300, 12,400, you could see a 1,500-1,600 point move pending on the bank Nifty itself. But all said and done, again, a 400-500 point correction on the bank Nifty itself would give you better risk rewards, and the conviction of the trade would be slightly higher in that case. So the sector continues to look good, and ICICI Bank would be the top pick. That stock has not performed, and within the bank Nifty it's a 40% weighted stock, so it has to move. And 1,080, 1,100 has been a very, very strong support going for over the last now 15-20 days. So this should be the launch pad for ICICI Bank, and that should be the stock to look at in the bank.
What about Reliance?
Reliance is lagging in price, time, everything to what Sensex or Nifty had probably done. But one important thing and one very good point about Reliance is that it continues to trade within a bull market channel, a 99-2008 bull market channel, for which Nifty is probably already done a 50-60% retracement. Reliance is still struggling, but it's still on that channel nearby. Once it breaks out of 1140, I think it would be a stock to look at again. Just like ICICI Bank, in the heavyweight space, a major laggard. I think big catch up on both these two stocks pending, Reliance and ICICI.
Okay, all right, fair enough. We'll have to leave it at that for now. Sarvendra, thanks for coming down to our studios. Appreciate your time as always. Mr. Raman, hope to see a lot more of you, sir. Thanks for joining us from Chennai.
Thank you.
Great talking to you as always.